Hi everyone, welcome to my Sweet Luck. I'm Michael here. The Dhandho Investor Summary, Chapter 12, Dhandho 401, Margin of Safety. All right. Previous chapter we covered about arbitrage and the types of arbitrage and the importance of it. And the next chapter will be about more in depth on the companies that Pabrai has invested, some real life examples, and how important it is to invest in low risk business, low risk and high uncertainty business. Uh, more details on that, more info on that. So this is a very short chapter, but it's one of the important value or point or checklist that you must have. It's about margin of safety, and this have been emphasized by a lot of investment gurus, Benjamin Graham and Charlie Munger, Warren Buffett. All of them have always stated that margin of safety is very, very important. Okay, so let's get started. One of the important idea in the Intelligent Investor book by Benjamin Graham, recommended by Buffett, is margin of safety. Buying a business for way less that you think it is conservatively worth. When we buy an asset for substantially less than its intrinsic value, we reduce downside risk. And looking at Warren Buffett, Phil Town, in a video, he mentioned that in his podcast with his daughter, he mentioned that Warren Buffett keeps the margin of safety at 50%. That means the intrinsic value is 50% more than the price that he's buying. That means it's more. It's discounted at 50%. Yes, that's the idea. So that's Warren Buffett's price point for margin of safety. For example, 10.6 a $10.6 million investment by Berkshire in Washington Post is now worth over $1.3 billion, over 124 times the original investment. Buffett bought his Washington Post stake at a 75% discount to intrinsic value. So minimum is 50%. More than that is bonus. As Benjamin Graham told Senator Fulbright, all discounts to intrinsic value eventually close. Mr. Buffett knew that this gap was likely to close in a few years. It is during times of extreme distress and pessimism that rationality goes out the window and prices of certain assets go well below their underlying intrinsic value. You gotta have an eagle eye. Watch and observe all your portfolios. Check out your watch list, and do look at the companies that you intend to buy, and look at the price. Problems, disasters, these are great opportunities for you to buy them at a great discount, because what they say is right, because eventually the market and the intrinsic value and the discounts will get close, eventually close. So that's why you make the money. So you make money by waiting. Margin of safety, it's very, very important. So the additional detail that I found is 50%, minimum of 50% of margin of safety set by Warren Buffett to buy companies. So wish you all the best. Thank you. Do discuss, do give your suggestion, do give your feedback, do follow my Sweet Luck, and I wish you my sweet luck too. Take care.